All right, my friends. So I welcome you all to another session, and this is for cash settled share-based payments. We are discussing IFRS 2 right now. So before we even begin doing this fabulous question, which is about cash settled share-based payments, let us just revise what we actually studied about cash settled share-based payments. An example, an examination example of cash settled share based payments is about when your examiner talks about share appreciation rights. It is a scenario in which your holder is going to be paid cash based on the intrinsic value of shares. The accounting entry should be to recognize a debit expense or an asset and a credit financial liability. You will use fair value at the reporting date for measurement, and that means you are going to mark to market. That is, you are going to face the risk of fair value changes in your own books because you have to pay cash to that person. Now, right now, I'm going to discuss a very good, very classical example of cash settled share-based payment. If you do this example, this is a very long example, but if you do this example in its entirety, much of the things under this scenario would be covered. So I would really request you guys to just look at this question pretty carefully, and this will give you a very good head start towards any question that you do after this. So your examiner says that just even before I move, just see that the requirement is for 5 years. All right. So whatever we are going to do, we are going to do it for 5 long years. So it is going to be lengthy in that regard. It start off as on 1st January 20x1, an entity grants 100 cash share appreciation rights to each of its 500 employees. So 1st January x1 is basically the grant date, the date at which an instrument is granted to some to the other person. We have 100 share appreciation right, SARs. That means this is a question of cash settled share based payments. And we are talking about our scope is of 500 employees. On condition that the employees continue to work for the entity until 31st December 20x3. On the condition that the employees continue to work for the entity until 31st December x3. That means this is the vesting condition. And by now you must have guessed it very right. This is a non-market based vesting condition. And this is a with service condition vesting condition. The condition is to stay with the company for 3 years. All right. Now, since this is a with service condition question, the time period has been defined of 3 years vesting period. So for sure, the expense of employment services has to be recognized over a 3-year period. So 1 out of 3, 2 out of 3, and 3 out of 3 has to be done in this question. All right, good. So the vesting condition is 3 years. Now the first year examiner talks about, it says during 20x1, 35 employees leave. Out of the total 500 employees that were covered under the scheme, 35 employees leave. But you remember from our previous lectures that IFRS 2 requires that you shouldn't only consider the employees that have actually left till now, but you should consider the whole vesting period. You need to have a broader horizon in that regard. Consider the whole 3-year period. Now your examiner says the entity estimates that a further means in addition to those who have actually left, in addition to those who have actually left, further 60 will leave during the next 2 years. So in this case, if I ask you a 3-year estimate, what would you say? You would say 35 employees have already left. And in the next 2 years, not all 3 years the examiner is talking about, the next 2 years, 60 employees will leave. So that means you are expecting on at the first year end that 95 employees would be leaving in the 3-year period. Hence, these employees won't be eligible for a share-based payment for an exercise of SARS. So that means out of 500, only 405 would be eligible. This is what we understand by the end of year 1. If you talk about year 2, examiner says that during 20x2, 40 employees leave. You do remember that 35 employees actually left in year 1. Then further 40 employees actually leave in year 2. And now the examiner says that an entity estimates that a further 25 will leave during the next year. That means that further 25 is an estimate. So in total, if you see 40 plus 25 is 65, 65 plus 35 would be 100 employees. So now you expect 100 employees won't be eligible for exercising SARS. All right. So this is your estimate for the next year. This you didn't have in the first year. In the last year, examiner says during 20x3, 22 employees actually leaves. Now, no further estimate has been given by our examiner because no further estimate is in any case required. Now we have a real 3-year data. We don't need to estimate anything because the vesting period is now over. 35 employees actually left in year 1. 40 employees actually left in year 2. So that is 75. Another 22 leave in year 3. That is actual as well. So this means we are talking about 97 employees not being eligible. 97 employees not being eligible. All right. So that means 403 will be eligible. Now, my friends, we have seen this 3-year data. Why don't we go and solve this question for the 3 years only first, and then I'll talk about what's remaining. All right. So I'll just start solving it here. First of all, I'm going to solve about what was the year end again? Yes. So it was 31st December 20x1. All right. So we are talking about the first year now. So in total, we had, I believe we had 500 employees. If you look here, we had 500 employees. And in the first year, our estimate was that 35 have actually gone, 60 will further go, 95, in total didn't have to be eligible. So that means 500 minus 95, that means only 405 will be eligible. 405 will be eligible. Those who are eligible, my friends, those who are eligible will each have 100 SARs. 100 SARs. So I write 100 SARs here. 405 employees, each with 100 SARs. Now we have 40,500 SARs. But what is the value of those SARs? Now you remember that under cash settled share based payments, we had to use fair value at reporting date. We had to use fair value at reporting date. So here, do we have any fair values at reporting date? Look here, look here. The fair values of the SARs for each year in which a liability exists are shown below, including the intrinsic values. So if you see at the end of year 1, the examiner has given us fair value of 14.4. We are going to use fair value at reporting date because we have promised the holder cash based on the value of shares. Now the market value of shares can go up or down, so we are exposed to fair values. We are going to market our instrument each year. So 14.4 it is. And now since the vesting condition was 3 years and we are standing in the first year only, what we are going to do is 1 divided by 3. All right. So let us just calculate it in that regard. What we'll do is 405 into 100 into 14.4 divided by 3. It is 194,400. All right. So this is the number that we have with us. What is going to be the accounting entry for this? We will say employment expense or salary expense, if you may say. Employment expense will be debited by 194,400 and equity option will be credited by 194,400. Done. So this is the accounting entry for first year. Without any further ado, let's move on to year 2. Year ended 31st December X2. Now here, if we go and look back, what was our estimate? Our estimate was now 100 employees who are not going to be eligible for share options or for SARS. All right. So that means in total, we have 500 employees. 100 are not going to be eligible. That means only 400 are going to be eligible. Each of them will have 100 SARs. And these SARs will be valued at. Let's go back. Look at the fair value. This is 15.5. So the fair value is 15.5. And we will do multiply by 2 by 3 because we are in the second year. Now, once we are done with that, we are going to get an as at figure. You see, we have done this 2 out of 3. That means 2 years have passed. This is a cumulative number, which means that we will get an as at value. So 400 into 100 into 15.5 into 2 divided by 3, we get a cumulative amount as 413,333. All right. Excuse me. Now we need to less, as we used to do in past, we need to less already recognized from here. And that number is what we had already recognized, what charge we had already recognized with respect to these SARs in the first year. It was 194,400. So we are going to subtract it from here. 194,400. And hence we are going to get a value of 218,933. This is for the year value of year 2. As soon as we get this value, we are going to perform an accounting entry. Expense is going to be debited by this amount 218,933. And against this we, oh my God, I just didn't realize I did a mistake. I'm sorry. It was not equity option. Since we are talking about share-based, for cash settled share-based payments, it is going to be financial liability. My sincere apologies for that. So expense debit in the second year 2, expense debit 218,933 and financial liability credit 218,933. All right. So up till now, nothing we have done which is quite unique. It is the same way that we used to do in past. Nothing is new right now. But year 3, year ended 31st of December 20x3 may be different. Just hold up tight. Some things may be different. Look at it. Let's go back. In the third year, which is the final year by the way, we realize that 97 employees have actually left, right? So if we see at the third year, just focus here, 97 employees have actually left. So that means we have 403 employees who are eligible now. All right. 97 employees have left. That means we have 403 employees left with us. All right. And this is the final year, right? The vest date has arrived. If you look here, your examiner says that at 31st December X3, which is by the way the vest date, the final date, people become eligible at this date. So 403 employees have already become eligible. At 31st December X3, 150 employees exercise their SARS. Just wait and watch what I'm trying to tell you. On the third year means we are talking about 31st December X3. There were total of 403 employees who were eligible to exercise their SARS. But your examiner says that on this date, 150 employees exercise their SARS. Now this also means that 253 employees, the remaining employees, 403 minus 150, remaining employees did not exercise. On the same day, 150 employees exercised. However, 253 employees did not exercise. Now the question comes into your mind that why the remaining employees did not exercise. Because I told you in my introduction lecture, vest date does not necessarily mean the exercise date. My friends, it is quite possible that people exercise their rights even 1 year after, or 2 year after, or 3 year after. Whenever they want to do it, they can do it. That all depends on the conditions that people have. All right. So 403 employees exercised on the same date. They would have been paid cash at intrinsic value. But the remaining 253 employees decided, okay, we will not exercise today, we will exercise this in future. Maybe next year or next year. And you can see this from the question as well. Another 140 employees exercised their SARS on 31st December X4. So for example, if I talk about fourth year, 253 employees would still be remaining, because out of 403, 150 had already exercised in the same year. Fourth year, we would have remaining 253 employees with us. Your examiner again says 140 employees exercise. Now, when they exercise, they would have been paid cash at intrinsic value in the next year. But out of 253, only 140 exercise. That means 113 employees would still be remaining, did not exercise. Now, well, when they exercise, maybe next year or the next year, if you look at the question, examiner says the remaining 113 exercise their SARS at the end of X5. By X5, everything was complete. So this question actually prolongs till year 5 because of the fact that exercise date is not always equal to vest date. Now we'll solve each year one by one. First, let us do 31st December X3 1 year. We'll do third year first. And I'll draw it again. How many employees did we have? Eligible employees? 500. How many? Minus 35, minus 40, minus 22, we had 403 employees. All right. Some of them exercised on the same date. How many exercised? 150 employees exercised. All right. So what would have happened about these 150 employees who had exercised? For them, you see, each 150 employees that would have exercised on that date, each would have 100 SARs. And each would have been paid cash based on the intrinsic value of shares. If you go back to the question and if you look at 20x3, you can clearly see that intrinsic value is given by the examiner, and that is $15 for the third year. So 150 employees with each with 100 SARs would be paid $15. $15. So how much payment would it come to? 150 into 100 into 15, which means 225,000 cash would have been paid to them. What would be the accounting entry of making this payment? We will do financial liability debit 225,000, because our liability is now over. We had an obligation to deliver cash, we have delivered cash, the liability is going to be debited, and cash debit to 25,000. This is going to be the accounting entry for those who have exercised their SARs. But still there are some employees who have not yet exercised. You remember how many employees were there? There were 253 employees at the end of year 3 who had not yet been exercised their SARs. What we do about them? The remaining 253 employees, each having 100 SARs, would again be mark to marketed. This obligation would again be valued at fair value. Do you know why? Because we still have an obligation to deliver cash to them, and that too based on the intrinsic value of shares. So the exposure is still on us. If they don't exercise, we are carrying exposure on us. Yes, we are saving cash. We are not paying them, we are saving cash, but we are carrying exposure on them. So 253 employees, each with 100 SARs, and the fair value is 18.2. 18.2 fair value. Per SAR. And this is obviously, this is the third year, so everyone is eligible to, it is 3/3. So when we do this, we get an as at figure of the remaining employees, and that is going to be 253 into 100 into 18.2. So this comes at 460,460. As per our past practice, we would say, okay, we will subtract what we have already recognized, so that we get for the year figure. Now, if I ask you what already in the books of accounts we had already recognized. If you see, my friends, and this is the turning point, this is one thing that you need to understand pretty carefully. Till year 2, we had recognized 413,333. 194,400 in year 1, 218,933 in year 2. So in total it becomes 413,333 cumulatively for the 2-year period. We have already recognized 413,333 in 2 years. But you also need to consider this fact, my friends, that out of this 413,333 liability, $225,000 of liability has already been finished. You see, we debited our liability. Just before this, we debited our liability. So what is already remaining in our books of accounts? 413,333 was till last year. Out of this 413,333, some have exercised, and for them the liability is over. So the remaining liability in our books would be 413,333 minus 225,000. It is 188,333. So what would be the for the year charge? what would be the for the year charge? It is 460 minus 188 it comes to, sorry, so the for the year charge, would be, my friends, 272127. And what accounting entry are we going to prepare? It is going to be expense debit 272127 and a financial liability still being credited 272127. Although the 3-year period is over, but since everyone has not yet exercised, we are still carrying a liability in our books. Now, if you look at it, this is something very much different from what we discussed in share options, equity settled share based payment. In equity settled share based payment, our obligation is complete at the vest date. Because once we know who are our eligible employees, whenever they exercise, the fair value risk is upon them. We don't care. We have promised you a certain amount of shares. We have recognized equity in that equity into that respect. Now we really don't care when you come and exercise those shares. The gain or losses of the market are going to be yours. But in the case of cash settled share based payment, we are obliged to pay the intrinsic value of those shares that we have promised them. Now, till they are not paid, and if the market goes up, we are exposed to it. If the market goes down, we'll get a gain of it. So we are exposed, right? So we are carrying our liability in our books till the time everyone has not yet exercised. And that is the reason in SARS, companies limit the exercise period after the vest date. It cannot be forever. So normally, it's a market norm that about 1 or 2 year period exercise period is given usually, but not more than that. So now we continue towards the next year, which is the year ended 31st December X4. And now we have 253 employees from last year who have still not yet exercised. But during this year, some people exercised. I'll just recall how many people exercised. So 140 people exercised and 113 still remained. So 140 people exercised. Now, my friends, if 140 people exercised, each had 100 SARs. Each had 100 SARs. Each of them would be paid according to the intrinsic value of those SARs, right? Fair value minus exercise price. If we go back and see the intrinsic value on X4 is $20. So each of the remaining employees would be paid $20. Now, if you see, they actually benefited. If you logically see, they actually benefited. Those who exited in the year 3 were paid $15 per SAR. Those who exited in year 4, they are paid $20 per SAR because the share price has gone up. Now it was a risk. It could also have gone down, but this is the risk they took, and they are earning. So my friends, 140 into 100 into 20 means that $280,000 of payment has to be done to them. So the accounting entry would be financial liability to 80,000 debit and cash credit to 80,000. All right. Now still there are some employees who have not yet exercised. What do we do about them? There are 113 employees who are still remaining. To those who are still remaining, we are still carrying on their liability. 113 employees, each have 100 SARs. We are going to carry their liability. The fair value of each SAR at the end of X4 is 21.4. If you go back to the question and see, it is 21.4. So the amount comes as 113 into 100 into 21.4. So we have an ultimate as at value of 241820. As per our practice, we are going to subtract from here what has to be what is already recognized, right? What had we recognized already in the previous periods? What? So we had already recognized till the last year, we had recognized 460460. That is the as at figure of last year. So 460460 was already there. But this year we have written off a liability of 280,000 against a payment made to them. So we will subtract 280,000 because it has already been debited in our books and not remaining in our books. All right. So just wait for a second, please. So 460 minus 280,000, it is 180,460 241820. Our for the year charge is 61360. The accounting entry is going to be expense debit 61360, financial liability credit by the same amount. Now my friends, the last year 31st December X5. You guys do remember, I hope you guys do remember that it was written in the question that all the remaining 113 employees had exercised their SARs by the end of X5. All 113. So everyone has exercise. So there were 113 employees, my friends. 113 employees, each having 100 SARs, and they will be paid intrinsic value. And they will be paid intrinsic value. What is the intrinsic value? Come on, just go on to the question and see what is the intrinsic value in last year. You see, intrinsic value is not given. Why? Because we studied in our opening lecture. At the end date, intrinsic value is always equal to market value. So even if it is not given, it is there in terms of market value. Market value equals intrinsic value at the last year. So okay, we are going to take that as 25. So it is 113 into 100 into 25. So it is 282,500 of payment to be made. So if we have to make a payment of 282,500, we will credit our cash as 282,500. Now we have to write off all the liability that we had. In our books, we had a liability as at previous period of 241,820. So financial liability will be debited by 241,820, and the balancing figure would be a P&L charge of 40680. Now you may ask that, sir, why are we carrying on a P&L charge? Because last year we booked a liability of 21.4, and my dear students, the actual payment is being made at $25. Hence we have to make a P&L charge of the fair value changes of from last year till this year. All right. So I always say that this is a very good question, very detailed question. And after this question, I don't think any cash settled share-based payment question would be a problem for you. It is, it is an in-depth example. And even in your SBR examinations, this extent is not tested. But this is end-to-end a scenario of how a real life share appreciation right actually works. Mm-hmm. uh, I think I'm going to give you a homework in this. Just look at this example number 2. This is also available in your notes. Do this example. Do this example. This is a very easy example, similar to what we just did in example number, in the last example. I don't think it's going to be anywhere difficult for you guys, and cash settle share based payment would be very easy for you. Just do that and let me know your feedback. I thank you. This is what a numerical example looks like for cash settle share based payment. I'll see you one more time in the IFRS 2 series, because there is some special areas still remaining, and we'll cover in the short lectures to come. Thank you. Have a good day. Bye.